Welcome to the deep dive. Today, our mission is, well, it's laser focused. We're going right into the deep, dark heart of options risk management.
We really are.
We're tackling a crucial and, frankly, a very counterintuitive paradox in quantitative finance. And that is, why do the very strategies designed to make your portfolio risk neutral, safe, suddenly become the single most dangerous factor when volatility really hits?
It's the ultimate betrayal of a safety mechanism, isn't it? The standard tools, your delta neutrality, your vega neutrality, they're supposed to be your foundation.
The bedrock.
Exactly. But our source material, which is a detailed Q&A with a high-level derivatives expert, it outlines their painful discovery that in truly stressed live markets, these safety nets just failed repeatedly, and that led to accelerating really disproportionate losses.
And that initial realization is really where the story kicks off.
Yeah.
The expert noticed that their capital losses were not caused by directional market moves.
No, not at all.
They weren't losing because they were wrong about a stock going up or down. They were losing because their supposedly stable neutral position experienced this nonlinear acceleration of losses.
Precisely. And this wasn't minor slippage or, a bit of bad luck. This was the entire structure of risk turning explosive. And it forced them to abandon traditional model and adopt what they called a risk-first approach.
A risk-first approach.
Right. They realized you just couldn't trust static neutrality as a protective measure. You had to identify, you had to map, and then stress test the structural weak points where that neutrality had to break.
So for you, the learner, that's what we're going to unpack, that whole journey. We're going to look at the 3 hidden risk factors: gamma walls, term structure distortion, and convexity explosion, that can turn a vanilla neutral position into a highly explosive one.
And we should probably start with the most basic building block of options risk.
The failure of first-order neutrality.
Delta neutrality. It's merely local protection. It means the slope of your profit and loss curve is flat, but it's flat only for the moment of entry. Our expert confirmed what every seasoned quant knows. Delta and vega neutrality are only really effective the second you put the trade on.
Okay, let's unpack that mathematically, because this is where the speed of risk just accelerates. Delta is the slope, so you're protected from small moves. But if the market moves even a tiny bit, that slope changes instantly. Why does it change so fast?
2 words. Because of gamma. Gamma is the second derivative. It's the rate of change of delta. So if you think of delta as the velocity of your P&L,
then gamma is the acceleration.
Gamma is the acceleration. If your position has high gamma, your P&L curve is highly curved. Risk doesn't just grow, it metastasizes very, very quickly. Delta neutrality is local, but gamma is the fuse determining how fast your protection just vanishes.
That makes perfect sense intuitively. If the acceleration is massive, your risk posture just changes in an instant. But this brings up the classic and very vexing problem of hedging. If you see delta changing, why not just hedge more frequently? If the slope changes, just flatten out again, right? Seconds later.
And that is the siren song of overhedging. While frequent hedging seems like the obvious solution, constantly resetting that zero slope, it introduces 2 huge structural risks that often defeat the whole purpose.
Which are?
Execution risk, and counterintuitively, it actually amplifies your gamma exposure.
Okay, help us understand that amplification. How does trying to protect yourself actually turn up the volume on the risk itself?
Well, you're chasing the market. Near expiry, options have massive gamma. So if the underlying price ticks up even a tiny fraction, your delta might jump from, say, -0.1 to -0.6 instantly.
Wow.
So you are immediately forced to buy a disproportionately large amount of stock just to reflatten your position.
And when you execute those large, sudden orders, you're introducing execution, risk slippage, market impact, potentially even moving the price against yourself, which then forces you to hedge again.
Precisely. The backtesting the expert ran confirmed this process wasn't stabilizing the book. It was actually increasing the P&L volatility. The very act of hedging, especially in those high gamma, low liquidity zones, it makes the whole portfolio jumpier, more sanitative.
So you're throwing money and effort at the problem. But the structural risk, the convexity, means you're just making the whole thing unstable.
Exactly. And it's crucial to note they confirmed this was structural. It wasn't just, a few bad execution days. The expert used backtesting specifically to falsify their risk assumptions, not just to prove profitability. And the recurring failure patterns, especially when implied volatility expanded or near expiry, proved this nonlinear breakdown was just inherent to the options themselves.
It was a realization that their risk model was fundamentally wrong when it mattered most. So if delta neutrality is fragile because of the movement of the underlying price, because of gamma, we have to address the second major layer of failure, vega neutrality, which is fragile because of the complex, shifting landscape of implied volatility itself.
Right. If delta tells you how you react to price, vega tells you how you react to market fear. Vega neutrality aims to protect you if the market suddenly becomes more or less fearful, causing volatility IV to rise or fall. But this safety, it relies on one critical, unspoken, and false assumption embedded in standard risk models.
The assumption that volatility shifts in a nice, orderly, parallel manner.
Correct. The model assumes if the average market 5E goes up by 1 point, the IV for all options, short-dated, long-dated, the deep out-of-the-money ones, they all move up uniformly. But the real market, especially under stress, it behaves more like an earthquake than a gentle tide.
Introduces to term structure distortion. This seems to be the core reason vega neutrality breaks down.
It is. In healthy conditions, the IV curve across different expiries is smooth. We usually see a slight contango where long-term IV is a bit higher than short-term. That's the normal term structure.
Okay.
Distortion happens when fear hits, and the market doesn't have time to process it evenly across the board.
And what does that distortion actually look like in practice?
The short-term IV explodes, while the long-term IV barely moves at all. You can think of it like a localized panic attack. Our source noted some extreme examples. Weekly FAVI could jump from 12% to 25% because of some looming event,
A huge jump.
while the options expiring 6 months out might only nudge up by, say, 1%.
Wow. So your vega neutral portfolio, which was built assuming that 1% rise across the board, is suddenly facing a catastrophic, localized 13-point IV jump on the short end, exactly where your vega is most sensitive.
And that localized fear shift completely breaks neutrality. It leads to massive, disproportionate losses concentrated precisely where the IV curves steepen most aggressively, right at the front end. Neutrality breaks not because the level of IV changed, but because the shape of the IV curve changed.
So we've talked about how IV shifts across time, but we also have to talk about how it shifts across strike prices. The volatility surface shapes are essential here, right? They reveal the market's expectations for tail risk.
They do. They act as the market's seismograph of fear. And we really need to understand the 3 core shapes, starting with the volatility smirk, which is classic in equity markets.
Right, that's the one that shows asymmetric fear.
Precisely. If you plot the IV across strike prices, you see the IV is highest on the downside. The out-of-the-money, or OTM, puts, and lowest on the upside calls. It forms a recognizable slant, or a smirk, and this just reflects the ingrained crash risk premium in equities. Traders are inherently more willing to pay up for protection against a downside shock than for a massive upside rally.
Okay, next up is the volatility smile.
The smile is symmetrical. Both deep OTM puts and deep OTM calls trade at higher 5E than the at-the-money options, so it forms a U-shape. This is really common in foreign exchange, FX, and commodity markets where large moves are expected in either direction. The market is worried about extreme volatility, but it lacks a clear directional bias for that move.
And finally, skew flattening. This is the market sort of
Yeah.
exhaling, right?
That's the sign of decompression.
Yeah.
Exactly. Skew flattening means that fear premium, the difference between the OTM put vol and the OTM call vol, is shrinking. When that steep angle in the smirk reduces and the curve becomes more horizontal, it signals that the market is calmer. Traders are no longer aggressively paying the price for downside protection.
Understanding those shifts, smirk, smile, and flattening, tells you exactly how the market is pricing different types of tail risk. But recognizing them is only the starting point. Let's look at the experts' response. The practical tools they developed to actively manage these second-order risks that destroy neutrality.
This leads us directly to something they called convexity mapping. Since we've established that gamma, or convexity, is the killer, the goal was to create a visual map of exactly where that risk was concentrated across all the strikes and expiries in the book.
So this is like creating a structural blueprint of your portfolio's weaknesses.
It is. Convexity mapping allows you to proactively identify these specific zones, certain strikes, certain expiries, where even a small spot move can lead to a disproportionately large delta change and an explosive nonlinear P&L acceleration. It stops being an abstract number and starts becoming a location on a map you need to avoid or heavily monitor.
And that fragility mapping completely changed the crucial process of stress testing. So the experts stopped stressing their book by arbitrary percentages, which is standard practice across across so much of finance. They didn't just ask, what happens if the price moves 1%?
And here's where the insight becomes really actionable for you, the learner. They shifted to stressing spot into the high gamma regions.
That is the core realization, isn't it? The risk depends far more on where the price moves than how much it moves.
Absolutely. If the biggest concentration of gamma, the highest curvature, is located at, say, strike A, you stress test by simulating the price moving exactly to strike A. Whether that move is 0.5% or 5% is less important than hitting the structural weak point that you identified on the convexity map. That's the difference between simulating a mild ride and simulating a structural collapse.
And they applied the same customized logic to volatility testing. They realized stressing for parallel IV shifts was, well, meaningless because failure always came from that shape distortion.
Correct. So they stressed volatility by deliberately distorting the skew. They would aggressively increase the near expiry in the OTM IV far more than the at-the-money or the back-month options. And this technique was designed to immediately reveal hidden vega and convexity risk that a static parallel shift model would simply never, ever capture.
And this proactive approach is so key. This isn't just modeling past losses. The high gamma concentration points in the structure of the vol surface are observable ex ante from the option chain itself. You can see the risk building before the loss even registers on your P&L.
It's not about prediction. It's about identifying the tripwires, the structural failure points where neutrality is guaranteed to collapse if the market just happens to wander into that zone.
Let's synthesize these risks then. Let's look at the three most explosive conditions that, when combined, led to those catastrophic nonlinear losses. We can start with the gamma wall.
A gamma wall is exactly what it sounds like. A mountain spiking up on that curvature map. It's a strike where gamma is extremely high, often because of massive open interest or right as an option approaches expiration. When the spot price approaches that wall, that liquidity barrier, the instantaneous delta change becomes massive.
And that forces hedging flows that just flood the market. It's a self-reinforcing instability loop. So neutrality doesn't just decay, it collapses instantly.
Exactly. The pressure becomes unsustainable. The second explosive risk is the convexity explosion near expiry. For most of an option's life, gamma changes pretty slowly. But in the final 1 or 2 days, that gamma curve goes almost vertical.
That sounds like a financial black hole.
It is. Delta neutrality, even if you try to reset it, lasts for seconds. The P&L becomes hypersensitive to every single tick in the underlying price, which makes hedging completely unstable and often impossible to execute without massive slippage. This really demonstrates why short options, even if they're delta neutral, carry such hidden, explosive convexity risk in their final hours.
So term structure distortion breaks vega neutrality, gamma walls break delta neutrality, and that convexity explosion near expiry makes both of them hyper-fragile. What should you, the learner, be monitoring in real time beyond those static Greek numbers?
You need dynamic monitoring. You have to stop looking at static delta and vega levels and focus intensely on changes in convexity concentration and, critically, volatility surface distortion over time.
So what are the early warning signs they focus on, before the P&L actually reflected the danger?
A sudden migration of gamma toward the spot price. That is, the risk is moving closer to your current position. Or rapid skew steepening, which signals that downside fear premium is suddenly skyrocketing. These shifts precede the structural instability before the profit and loss ledger even registers the danger.
And what triggers the ultimate decision to override your conviction? Because every trader has a view on the market.
The trigger is simple, and it's based purely on risk. It's when small market moves start producing outsized P&L changes. That is the moment the structural instability takes over. At that point, preserving optionality in capital matters far more than holding on to a market view that the structure of your trade can no longer support.
This whole discussion seems to synthesize into one key and, I guess, painful lesson about risk philosophy.
The biggest risk mistake outlined by the expert is treating neutrality as safety instead of as a temporary unstable state.
Unstable is the key word there.
It is. They initially assumed neutrality would buy them time to react, but under stress, they found it actually compressed their reaction window. By delaying intervention, relying on this illusion of safety, losses became irreversible before they could even hit the exit button.
And this brings us back to the crucial role of human judgment. Automation can flag every convexity spike and surface distortion you program it for, but the expert emphasized that regime interpretation should never be fully automated.
Right. Determining if those rapid shifts are merely transient market noise or a structural regime change, a true moment of instability that requires human insight and experience.
The ultimate lesson from this derivatives expert's journey is really profound. They learned to build systems not to predict profits, but explicitly to understand and contain risk. Now that you understand the mechanics of gamma walls, term structure distortion, and convexity explosion, consider this as you go deeper into the markets. If neutrality compresses your reaction time under stress, what single observable indicator of surface or gamma behavior would you trust most to signal a structural regime change that requires you to abandon your conviction?
We'll leave you to consider that critical balance between automated measurement and human interpretation until the next deep dive.